Hello, Trade Pros. First off, Happy New Year. Hope everyone had a great 2019 and is ready for a great 2020 in the world of stock markets and markets in general. Now, what we're going to be doing today is going through what happened in 2019 and getting you ready for 2020. So we're going to do an overview of the equity market in 2019 and what you can expect in 2020 based on a lot of key information and how to tackle those markets. Now, if you guys are new to this channel and you like what you see, if you don't want to miss any more videos, I want you guys to smash that subscribe button down below and hit that like button for more great content. What we're going to be doing in the few weeks here in January is showing you guys different outlooks on different markets between Forex, commodities, and bonds, and more. So if you don't want to miss that, a great chance to get ahead in 2020 in the world of trading. Stick around and we'll show you a great time, a great educational time. So without further ado, let's go ahead and get started right after this intro. Now, what we're going to be doing today is looking at what happened in 2019 first. So we're going to be going through a lot of key events: monetary policy, trade wars, QE4, repo rates, stock buybacks, and more. And then we're going to take those same key events and look at them in 2020, what may happen, what is set to happen, how it's already set up. And then we're going to be doing a market analysis for you guys and looking at the S&P 500. What can we expect in 2020 based on a lot of variables? Now, what happened in 2020 first? In 2020, the stock market opened at 2477 on the SPX after a pretty weak December from 2018 leading into it from a rate hike cycle. We had a yearly low of 2444, and then what happened after that? Markets just continued to rally and have not stopped. So if I jump into a chart here, an S&P 500 chart, you guys will see it clear as day that you can see right here. This was from December. We got about 16% drop, about 20% drop from the highs in 2018. And then if I go to the year to day right here, you can see this is where the year started, 2019, right at these 77s, and rocketed through the 3,000, 3,100, and 3,200, making an attempt at the 3,300 even. So a lot has happened and a lot has propelled this market up. Some may think it's artificially inflated based on a lot of the key events, but that's what we're here to talk about today. There were shifts in monetary policy, like I said, from a rate hike cycle to a rate cut cycle that was called a mid-cycle adjustment. The neutral rate that caused all the hiking was between 3.5% and 5%, not exact, but that is where Jerome Powell and the Fed saw the Fed fund rate to be in 2018 and really flipped the switch in 2019. Now we've ended the year with between 1.5 to 1.75% as the Fed fund rate. A great shift from getting up to that 5%, and that's what happened here. A lot of the stock market took that as an advantage and rallied with it, because money was cheaper to borrow, and where do people park that cheap money? In the market to see larger than borrowed returns. So there was a lot of correlation between the health of the economy and the health of the S&P, and it seems like Powell and Trump did a lot to support that, a lot to support the market, because that's where they thought the economy was headed. How do we continue this growth? Let's pump more money into the market. And that's what they did. Now, they did not quite mention that they're correlated at 100%. They would rather not. They're more focused on the data dependency of the Fed rather than the stock market dependency. But we all know that they want a strong market, especially during this presidency. That's why Trump kept pushing and pushing for cuts. There was a lot that happened: trade wars, QE4, and all that contributed to the rally of the market. So let's take a look at those main events, starting off with the monetary policy shift. Now, in 2018, like we said, it went from hikes to cuts. They hiked about 3 times, cut about 3 times, and they went from that neutral rate to a natural rate, it would seem, considering the neutral rate was nearing the 5% mark, as a lot of analysts expected in 2018. Now, they managed to cut 3 times in this mid-cycle adjustment in 2019, in July, September, and October. All those meetings were 25 basis point cuts. A lot had to do potentially with the inversion of the 2- and 10-year yield spread, which inverted just slightly and did not invert for long. It has rallied back to the positive rate, where in previous crashes, it inverted quite significantly and the crash came a lot after. So that's why people were pretty appalled and pretty scared that a potential recession was coming, but the inversion wasn't as cataclysmic as we saw in 2006 even. Nearly every time they did cut, though, the market managed to drop, which was a very interesting fact for a lot of people to note. Bad news became good news became bad news, and when bad news came out, bad economic data, markets went up because they expected, oh, okay, the Fed's going to cut again to sustain this growth. When good news came out, oh, they're not going to cut, that means let's sell everything. There's no more artificial inflation in terms of cheap cost of borrowing, which is a little backwards and doesn't really reflect the true value of the S&P or the economy for that matter. So why did they start cutting rates? The Fed claimed that they wanted to continue the economic growth as was, so there was a mid-cycle adjustment, which propelled more money into the economy. But I feel like we're going to look at this shortly, but in QT, so quantitative tightening between 2017 and 2019, they were really losing a lot of liquidity in the markets and the US dollar worldwide, and I feel like they wanted to jump back at that, which we'll talk about very shortly. But a main concern of the Feds was the inflation. The inflation targets were not growing at a certain rate, and they felt like cutting rates would help combat that inflation target miss. So that's where the mid-cycle adjustment came from, or as they said it did. But not a lot of the economic data was that bad on the forefront level, but maybe deep down they saw something that everyone else didn't, which propelled them to cut. Now, cutting, is it a good thing or a bad thing at this point? Well, if a potential recession and an economic collapse does come, they've kind of run out of a lot of bullets. If the current rate is between 1.5 and 1.75%, they can't really cut much from there. They're not going to be cutting 25 basis points if markets start tanking 10, 15% a day. They're going to be cutting 50 basis points, 75 basis points. But what's interesting to note is the cuts stopped just as soon as it was at the 75 basis point level for the year. Now, a lot of people think the 75 basis point is a max, meaning that anything above that in a year's time would equate to recession protection. And at that point, the Fed and the government might think that, okay, something big's coming, we have to start protecting ourselves and pumping more money, so we inflate the market so it has a higher level to drop from, so the drop isn't as cataclysmic. That could be a reason for why they stopped cutting rates, or maybe they felt like the current rate and what they've done in terms of stimulus was enough for the year. We won't know really, but those are speculative measures. In terms of where that leads on, we're looking at the trade war at this point. What happened in the trade war that helped the economy pump up other than the Fed? Now, there was a lot of tariff news which really moved the market sideways. So the market went up, down, every time new tariffs were announced. Now, obviously, China imports a lot more to the US than the US does in China, so the US had a lot more bullets in terms of tariffs, increasing the tariff amount to $550 billion on Chinese goods, while the US had $185 billion on their goods based on China. Now, it was a seesaw at the beginning of the year, especially throughout the summer. There was a lot of downside, and into the end of the year, we came into some kind of agreement where the phase one deal would be reached. So there is actually progress. Maybe not a deal reached in 2019, but Trump, as you know, wants to push it as far along, considering next year is a federal election year. So as long as he has a portion of the deal, which is maybe about 60% of the deal complete, into the new year, coming into the first few weeks of the new year, then he's getting in the good books with a lot of people, it would seem. Now, there were also tariff delays, which caused markets to move up. So on December 15th, there was scheduled tariffs to be implemented, an increase in tariffs. Trump paused that, also announced phase one deal is good to go. Markets rallied. However, you'll notice that in a lot of instances where there was bad news, especially on December 2nd, if we find that, you can see this huge red candle here. This was based on tariff threats looming over China and Trump and China not having that great of an agreement. So if we see a large push to the uncooperative side, let's say in 2020, we could see a lot of these red days plump up. You can see right here, this was right after the Fed cut, but there was also a lot of news based on China and the US not signing a deal anytime in the future, which caused a drop from about 30.20 all the way down into 28.40 just in a matter of days. So Trump and the trade talks have been a super cataclysmic event for the markets this year. And what we want to see in the coming year is a sustained growth in the partnership and cooperation for markets to continue to rally. Otherwise, we may see another nosedive. Now, going back to the Fed, only did the Fed cut rates multiple times, but thanks to the repo rates skyrocketing this year, they initiated what a lot of people think is QE4, even though they're not so quick to admit to that. Now, quantitative tightening happened throughout 2017 and 2019, where the Fed shed about $750 billion from the balance sheet, which decreased the liquidity of the US dollar severely in terms of reserve money. Now, the Fed started flooding money into the system this year, known as quantitative easing 4, which was due to a repo rate skyrocket. Repos are the overnight rates in which banks lend to each other of about 10% pop. The normal repo rate's around 2, maybe just under 2%. Now, once that 10% pop happened, that meant a huge shortage of liquidity, and the Fed just started pumping money into the market and into the economy. Now, what happened was the Fed may have saved another bank from terror, from just collapse based on this, but we won't know until 2 years in advance. That's when the information will actually come out. But considering what happened with this 10% pop, it's very unlikely that something of the sort did not happen. So that means that the Fed started actually pumping about $60 billion worth a month into the economy and propping this liquidity back up. So far, they've injected $300 billion. Now, this has covered about half of what the QT shed between those 2 years that were previously mentioned. This also increased the circulation in the world of the US dollar. Now, the Fed announced that they'll be resuming this 60 billion generation probably for about 6 months' time. And then after that, they will continue to flood the market with what is a more neutral amount between $10 and $30 billion a month. Now, if this isn't QE4, then I don't know what is. This is also another measure to protect against a potential recession, which may have had something to do with these repo pops. All this flood of money will continuously help the economy and the market go up. So if they continue this for the next year or so, we can see a lot of money propelled back into the system. And where does that money go? Into growth and into equities. So as we expect that to happen in 2020, we could see a potential push in equity markets again. In terms of stock buybacks and earnings this past year, we had $700 billion in buybacks. Now, granted, that was a little less than normal, a little less than previous years. This was a crazy amount of money. This is companies buying back their stocks and pumping those prices up. So they're kind of artificially inflating their prices, companies such as Apple that continue to buy back their stocks because they deem their actual intrinsic value higher than what it is now. So they buy those stocks back, pushing the stock price higher and continuously doing that throughout 2019. Now we'll shortly look at what we can expect in 2020 based on buybacks. But earnings were also a huge event this year. So the 12-month PE ratio is 17.9. It's above the 5-year average of 16.6. But there's a year-over-year decline in earnings and growth in revenue just slightly, but the earnings are missing. You can see the numbers here on the screen. But if they continue to drop like this and earnings continue to drop, then that kind of reflects a poor image and a false image of actually what these companies are supposed to be evaluated as, especially with all these buybacks. And we'll see if that'll continue in 2020. But we also saw a slight quarter-over-quarter fall in buybacks, but a lot of this contributed, the $700 billion contributed to a lot of the 30% gain in the market that we did see this year. Now, earnings over the last year were kind of weak, like I said, but the total impact, including lower business, investment, capital expenditures, inventory destocking, weaker commodities, prices, and a stronger US dollar have been reducing earnings per share, and they could continue to do this. So that means two things could happen out of the trade war. So if the trade war continues, then we could expect earnings to fall because of all these tariffs, which we'll look at soon. But if the trade war continues in the way it has been, and they're signing deal after deal, then we could see a pop in earnings, which will reflect a lot of the value in the stock. Now, speaking of 2020, what do we expect to happen in the coming year based on all of these criteria and all of these events? Well, first, if we look at the monetary policy shift, pretty easy to identify what we could expect, but everything also comes with a grain of salt. Now, this is the Fed dot plot. So the Fed dot plot elicits the largest number of circles right here is the expectation for the largest amount of voters in the Fed. So currently you can see 2019, we're spot on right in the middle between 1.5 and 1.75. Where is the next largest dot plot amount in 2020 at that same level? So Fed Chair Powell did say that they don't plan to change rates in 2020 whatsoever, but that's easier said than done considering we're just getting into 2020. A lot could change then, and this number could easily shift. But so far, we do expect changes in 2021, but we're only looking at 2020 for now. So if we continue to stay at this level, this again gives us less room to cut just in case something might happen. Also, these rates are still really, really low, making it very cheap to borrow and flood money back into the market. So even if they don't cut, the borrowing costs are very, very cheap, and we could see a continued growth in stock markets, especially if we see slight dips, maybe 2 to 5% dips in the market. These are going to get bought up very easily because, again, borrowing costs are so low, so why not get equities for a lot cheaper if they do manage to just plunge a little? Every little dip could get bought back considering this monetary policy shift and what may happen in 2020. In terms of the trade war, the trade news is phase one set. Is it set in stone? Until they sign it, not really. But if they continue this way, then we'll see a lot more progression in the market. And if tariffs just stagnate, like I doubt that they'll roll back tariffs, because what's the point of implementing those tariffs? They're just going to roll them back. They won't look as strong of a nation if either nation starts rolling tariffs back. Assuming tariffs stay as is and there's no threat of new tariffs, then there will be a continued move to the upside. If phase one is set to be signed, and then phase two is in the works, again, a lot more upside in the markets. Now, if phase one deteriorates, more tariffs are implemented, phase two is nowhere in the works, then you can see a pretty drastic drop in the markets. Now, in terms of the Fed QE4 repo rates. So, like I said before, there are months of QE4 pretty much expected, $60 billion, and then it's going to start between $10 and $30 billion a month. From there, even if it slows down to half the size, there's still money being flooded. But until it does, there's going to be a lot of money flooded into this market. And again, it's just going to propel the stock market higher and higher and higher. Now, once we see that expected slowdown actually come in, we might see a little dip. But until that happens, all the key events just point to an upward market unless things really, really deteriorate economically. And between China and the US, those are the two pivotal things that we're going to watch for in 2020. In terms of stock buybacks and earnings in 2020, if a deal is eventually hit, we will see a partial rollback in tariffs, not like taking tariffs back, but maybe stagnating the tariffs, which could turn into a strong earnings season if all else continues. Because if the tariffs remain the same, or if by some miracle they do get rolled back, that means all different areas, imports, exports from the two nations, based on what they contribute to China and the US, metals, whatever it is, they become cheaper and there's more production, there's more sales, and things get going. The gears start turning, right? Including a global cycle recovery and a pro-growth election sentiment. This is also the best case. We will see a pretty optimistic run in the S&P 500. If the deals fall through, we could enter an economic slowing cycle and earnings will not be pretty naturally. So we did talk about that just briefly before, but stock buybacks are expected to fall in 2020, which eliminates the artificially inflated valuation of a lot of companies. Earnings growth forecast in 2020 is also not looking the best. It has fallen from 12, nearly 13%, to 9.9, and even Goldman Sachs expects a 9% earnings per growth, which is said to be optimistic. So if this continues to fall, then we could see the valuation of the stock market actually come down into what is expected to be a neutral level. Now we're getting into the meat and potatoes. What does the chart projection tell us? Now there are a lot of variables to take into account, but we'll do our best job and we'll identify how to trade these markets the best we can. It might be a little difficult to swing trade this year unless there are cemented steps in all of the events that we had identified. But in terms of day trading, I feel like there's going to be a lot of opportunity with the volatility to come. You guys have to have a news squawk and keep an eye out and an ear out for any news events that really shake things up or could shake things up. Now let's go ahead and look at the market here on my screen and identify some key levels. Now, let's take a look at what we've got in this market. Now, we've seen a pretty drastic climb here. If we go on the monthly, if we go to the 1 month here, one candle equals 1 month, you can see a pretty drastic climb in the S&P 500. Now, we've risen, and each trend line that we draw becomes steeper and steeper, and eventually it's probably not going to be vertical, but we will see a slight pullback. It's just natural in the markets. We've had 4 straight months of green to end the year, which is amazing. It's a lot more than we could say for last year in 2018, but we've exceeded a lot of the volume to the upside. So the volume to the upside is really thin. And where could we land ourselves? The first area of longer term interest is going to be around 2950, as hard as that is to believe, because that is where this previous top is. Between 2950 and the 3020 level, we could see a slight pullback, which does bring us down about 7%, which isn't unnatural. At that point, we could see a lot of big money buying, especially with these super low rates. And if tariff news is good, you'll see a lot of guys, a lot of big money players start coming into the market and start buying at these levels. Why? Because these are very key levels based on previous broken highs. Now, it's pretty easy to see it here on the monthly because we've just skyrocketed to the moon with very little pullbacks. But I feel like we could expect a early 2020 pullback, just as all the institutional money finally floods back into the market. They see the weak volume to the upside, take advantage of the growth, and start selling for profit rather than panic selling. Selling for profit is completely different because they've made their money for the year. They're just rolling it back. And then we could see dip buying opportunities. Now, if we go down to a daily right here, you can see where these key levels are. So it's a little simpler to see. These are the previous highs. This is the area that I was watching out for an ultimate pullback, but this is where this impulse started. So we could see a pullback generally into the 3080 level. I feel like that's kind of a last chance, especially in the first few months, for these buyers to step in. If we drop in the first month through this previous broken peak at these 3150s, this is the first area of support. If the first month drops through this area and into this area, through this area, we could actually start switching to the downside and see a little deeper of a pullback, especially down to these 2870s. However, coming into this year, there's a lot of optimism built around everything that we've just mentioned today. So we could see the pullback stagnate right here. We don't even have to pull back. Price could just continue rocketing into the new year based on all this excitement. A lot of fund managers may be looking to reallocate, or maybe not even stepping in yet because it might be a little too overvalued if they don't have positions. Now, that's really what I'm watching out for here. If we do grab some of these areas with some of these fibs, as we normally do, we'll grab a fib retracement just based on this previous little drop here, peak. We can see that the areas to watch for, if I jump in and look at these settings, what I'm only looking for is a 50% pullback area. And what we're looking for is very close from this peak that kind of stagnated all the way down into this previous broken high. So between the 3150 and the 3160 is a very strong area to identify. If we actually pull this up a little, make it a little cleaner, is a very strong area to identify for that potential pullback. That's where a lot of buyers are waiting, and that's where a lot of potential stops are for longer term investors that have been in this for the whole year. Now, below that, if we continuously grab this to the previous broken area, the 50% pullback brings us back to this impulse start, which is pretty natural. Now, those are the key levels I'm expecting for pullbacks. If we do manage to crash through a lot of these levels, especially level number 1 right here, level number 2 right here, level number 3 right here, which is very close to level number 2, if we crash through all these levels, I think we are going to drop a pretty significant amount. However, we don't have to look at the doom and gloom only, we have to look at the upside. There's a lot of upside potential to this market, and if we look at a weekly, we may get a better view on that. Now, again, if we're just grabbing some of these peaks, again, this is very arbitrary, but we grab the low from what it seems of the year into this previous peak and then extend that like that, we'll have to actually blend that out, and we can see a very interesting target level at 3467. So my first target area was 3300 based on where we recently popped off, but a better area is between 3400 and 3500 for the end of the year. Now, I don't think we rocket right up and just touch that level. I do see a slight pullback, maybe even a deeper pullback before we get into that area. It's just healthy for this economy because the higher it gets, the faster it goes up, the thinner the volume on the upside. No one's going to be wanting to buy highs, especially if it climbs like this. People who have said, oh, it's too late for me here, are not going to start buying here. And once the retail money actually gets in, everyone's parents, whoever it is, that's when you know that that's a peak higher, that's a top. And that's kind of what seems like is going on currently. Sorry for this mess on the screen, but that seems like what's going on currently at this peak. We've climbed up so much green week after green week. We're expecting to pull back into those areas. So again, 3150 to 60 main area to watch for, and then below that, the 30-20 area. So those are going to be really, really key areas to watch for this year. In terms of day trading this thing, watch out for the volatility and trade that market structure. You have to keep an eye on the news and see what happens in terms of this trade deal. And all of the key events that we mentioned today are going to be super, super important in 2020. This was a little touch up. If you guys want to know more about where we do expect the market to go in terms of day trading and how to day trade it, just join our trading room. We trade live every day in the mornings, and we give everyone a very complete overview of what we expect on that session and what's to come. I really hope you guys enjoyed this video. This is Victoria from TRADEPRO Academy with an S&P 500 outlook for you all and how to get ready for 2020 based on a lot of key events. Now, take this all with a grain of salt and do the analysis for yourselves in terms of where you want to park your money, investment-wise and trading-wise. Hope you guys really enjoyed this video. Comment down below what you guys want to see. Smash that like button and hit that subscribe button.